Hey guys, how you doing? So Dan from Trading with Dan here. So this section is going to be on order types. So there are two main types of orders. There basically are only two orders, and you can have variations of these two types of orders. But what those two orders are market orders or price taker orders, and limit orders, which are price maker orders. So very simply, the difference between the two is a market order is an order that will execute immediately at the best possible price someone is offering in the market. A limit order is an order that you place at a price, and then you'd have to wait for someone to place a market order to fill you on that trade. So you would have to wait till someone actually fills you. You may get filled straight away, you may not get filled, you may never get filled depending on where you place your limit order, but a market order will always get filled. Obviously providing the market is open when you place the trade, but a market order will basically get filled whenever a market is trading. So say you were long an asset, so you'd bought, for example, some Bitcoin, and you saw the market going down, so you wanted to sell immediately at whatever price people would buy it off you at. So what you would do, you're in effect hitting the bid. It's called hitting the bid. So you're selling at the bid, which is the bid would be the highest price that someone is willing to buy from you at that particular point in time. So it's the opposite as well with if you say you had sold Bitcoin, you were short Bitcoin, and then you saw the price going up really quick and you wanted to basically stop out your short position, and so what you'd do is you'd have to lift the offer. So you would place a market order to buy to get you out of your short position, and the price you would buy is the lowest price someone at that time is willing to sell you at, sell you to for. So that would be what the offer price is. And obviously where those offers and bids come from, they come from people placing limit orders. So obviously a limit order is an order that isn't getting filled instantly. It may get filled pretty quickly, or it may actually get filled never, depending on where you place it. But nonetheless, you don't immediately transact when you place a limit order. You're waiting for somebody, like I said, to come in with a market order to either buy or sell your bid or offer to actually trade. So they are the two fundamental types of orders. A market order, basically one that will be executed immediately at the best price that people are offering at that point in the market and point in time in the market, or limit orders where you're in effect putting an order, you're creating liquidity in the market, and you're actually putting an order into the market. So obviously you can see if we have a functioning market, limit orders are actually more useful for the functioning of the market itself. So if you've got an exchange, you want people putting in bids and offers. You don't necessarily want everybody trading with market orders, because then it just simply wouldn't work. So because of that, you often get either no fees or actually a fee paid to you when you place a limit order, and then a market order then buys or sells into your limit order. And then obviously the opposite is true. If you're taking market orders in a market, then what you in effect are doing is taking liquidity out of that market. You're taking out those limit orders that are in the market that are helping that market function nice and smoothly. So you actually pay a fee to actually transact with that market order, to actually place that market order, and then obviously part of that fee then goes to the exchange because they provide the infrastructure, and then part of that fee then goes to the person that provided that liquidity that you bought or sold, which is the person that placed the limit order. Right, so now we've got those two individual order types, like we know what they are now. So then we have variations of those order types. So one of those variations is called a stop order. And you can have a stop order that will then place a limit order, a stop order that is a market order. More often than not though, a stop order will be a market order, and it's usually used for people as stop losses. But also breakout traders can use stop orders to basically sell or buy a market at a certain price. So these are orders to buy buy higher than the current price, or to sell at a lower price than the current price. So say for example Bitcoin is trading at 9,000 and you want to sell at 8,500. You would then place a stop order for 8,500, and you could want to do that for two reasons. One, you could want to take a short if the market gets down to 8,500 because you think the market is then going to go lower after you've potentially lost a level of support that was below 9,000. Or you could be long Bitcoin and your stop could be 8,500. So if you get down to 8,500, you then want to sell your position. But obviously you don't want to sell your position right away if you're holding one long, and then you also don't just want to sell the market here because we've potentially not broken below a support level that you've identified in the market. So, and then obviously that brings us to the different kind of stop and market orders. You can have a stop market order where this is just the same as we did in the first slide that we went over. A market order will just mean that your stop will just execute straight away at the price that you set it for. A stop limit order though, what will happen is when the market hits your price that you want to sell at, say 8,500, it will then place a limit order in to sell at say 8,505. So then you are then going to wait for that order to then get filled. But the problem with that, obviously, the market could just keep going down and then could maybe not hit your order. So I mean, stop limit orders are okay. But I would maybe only use them if you're actually using them to actually open a position or place a position. And even then I would probably still recommend just using a market order, because the reason you would place a stop order is because if you don't have a position to enter a position is because you think obviously the price is going to break down or break out, so you kind of don't want to miss the price and miss your trade if the market then keeps going. So what I would probably recommend is to use actually stop market orders. So if you're either stopping out a position, then you're guaranteed to get out of that position. You may not get the greatest price, but at least you are going to get a price, and it may basically not be as bad as the price could be if you stick in a stop limit order. There are also other kinds of stop limit orders you can use, especially on Bitmex, which are like called aggressive limit orders, but you'd have to use them with a software that would allow you to do it. So what would happen is you'd have a limit order that gets placed, but that limit order can then chase the price. So say you want to buy when the market hits 8,500, and then the market then starts going up, 8,501, 8,502, your limit order then will come up with the price. So as soon as the market has a downtick, you will then obviously get filled on your limit order because you will be just below the price. Right, so trading orders. So you can set a trading stop loss or trading take profit order. And obviously, as you can tell by the title, these are orders that trail the market. So and also these again can be limit orders or market orders. All this means any order can be a minute limit or a market order as long as that's basically how you want to play it. And obviously as long as you understand that the market order will be the only one that gets filled instantly and the limit order won't. So why would you use a trailing order? So okay, say you've got a position, you bought Bitcoin at 9,000 and it's starting to go up. Say it's gone up $100, so then you maybe want to set a trailing take profit order for $50 under that price. So if you come back to $9,050, then you will then take profit. Your trading order will take the profit. So what you're doing is just sort of giving yourself a bit of leeway. So say Bitcoin spikes up and all of a sudden goes to 9,500 in one big candle, then what will happen is then your stop loss order, trading stop loss, will trail with the price 9,500, and then will end up, if that's where the market tops at 9,500, your trailing stop loss, trading take profit will end up being 9,450. So then if the market then retraces a little bit, if it retraces that 50 points, it then stops you out and then locks in that profit. The similar is the same for a trading stop loss order, and that just basically means, say you've got a stop loss of 1% under the price that you bought at, and then the market goes up by 1%. That means your stop loss will trail the price by that 1%. And basically be at break even, because obviously it's up 1%, the market's up 1%, and your trading stop loss was 1%. So that it's similar to a take profit order, but obviously a trading stop loss can trigger even if your position is in a loss and not just a profit. So that means that you could buy at say 9,000, you could have your trading stop loss at 1%. The market could then go up 0.5%. And then go down 1%, and therefore it's 0.5% down from your entry, so you're in a loss, but it's 1% down from when the market actually went up to. So that's how a trailing stop loss would work. Right, so now that we know what these orders are and what stop losses are, and how to place them and which ones we'd want to place, we want to know where would we place stop orders. Right, so if you bought Bitcoin and you're long, and say you want to basically place a stop for that trade, what you'd want to do is place your stop order below a support level. So hopefully what would happen is if the market does come down, you'll get supported by that level, and then keep going back up, so you stay in your trade. If you're selling Bitcoin, you'd want to actually place your stop above a resistance order, a resistance level. So then what would happen if Bitcoin trades up to that resistant level and you're short, you would hope that that the resistance would then push Bitcoin back down again and put your position back into profit. And you don't really want to get stopped out at that level. But if we do break through that resistance, and obviously that would indicate we're going to have more of a move up, and you're short, you would then want to obviously hit your stop loss. So you need to then decide how you're going to identify these support and resistance levels. So common ways of doing this are to look at the order book, so you can see if there are any big bids under the market or big offers in the market that you can lean on. It's kind of called leaning on them. So say you bought Bitcoin at 9,000 and you know there's a big order to buy in the market at 8,900. You can then buy at 9,000, and then you can have your stop under 8,900 on the basis that you believe that big bid person does want to buy, and then he will stop your order getting down to below 8,900. So you're sort of leaning on his bid. But obviously be careful with that, because you can get spoof orders in the market, basically to try and squeeze up price and make it look like there's more buyers, to try and make the price go up. And then sometimes they can disappear once the price gets close to them, because they didn't actually want to get filled at that price in the end. So you have to be a bit careful with that. Also, identifying horizontal levels are important. I do this a lot with my trading. So I'll find areas of confluence, areas where markets have basically bounced off a few times before or been resisted at a few times before. So I know that traders are buying at that level. So I know that obviously they will be stops under those levels. But the main thing is that I know that there is basically demand at those levels. So then I know that I've got a better than average chance of market being bought at that level. And then I also kind of know if the market breaks through that level, that the market will keep on going. So at that point, I do just want to stop out. So placing a stop under support, we'll have a look at this example. So in the example, you see that if you go long after the resistance is broken, that resistance now becomes support. So this level becomes support. So you'd want to place your stop under that new level of support. So what will happen is the market then breaks the resistance, it goes up, it comes down, and it actually gets supported by that level of resistance, and then bounces and goes up. So your stop, you'd want your stop around this level, so underneath that resistance level. Sorry, it was your old resistance, but it's now new support, so underneath that support level. So you would hope if you're long, the position gets supported and goes up from there. But if it doesn't, and it goes under and the resistance is broke, support is broke at that point, then you know there's a good chance the market will keep going down. So you just want to cut your loss at that point. So that's how that kind of works. And obviously here's the opposite, so placing your stop above resistance. So if you've gone short this market after the support is broken, you'll probably want to place your stop around this area here. So that old support then you would hope will become new resistance. So we break down, we come back up, we test that old support that is now new resistance, and you would hope that resistance would then send the price back down. But if it doesn't, it will hit your stop just above it. But this is an area that you would identify as a good level for price to actually be resisted from. So you'd want to stay in your trade whilst ever we are basically below that level if you are in a short trade. So there we go, there's a few order types, how to use them, how to place your stops, and the sort of orders that you should use for that. So yeah, hopefully that was useful, guys, and I'll speak to you guys on the next video.